This is Weights and Wealth, your one-stop shop for entertaining education on building a stronger body and bank account.
We are not doctors or financial advisors and must warn you this is not medical or investing advice. It is for your entertainment.
Welcome back to Weights and Wealth. We've got episode 100. This is a big deal. We are so grateful for you guys supporting us throughout all of this. Obviously, I wasn't here the whole time, but Nick and Ted have been here since the beginning. So for episode 100, we figured the best way to celebrate this is to go over like the biggest breakthroughs and events in fitness and finance over the last 100 years. Obviously, we were not around the last 100 years, only a quarter of that. So it's kind of an interesting way to see, the whole way that society's come. So our shout out is George Hackenschmidt, The Way to Live. Ted, if you want to talk to us about that, because I think you actually read that.
Yeah, we've discussed this short book written in the early 1900s before on the show. I believe it was one of the early book club books when we used to just mention books for the book club at the end of a show. But George Hackenschmidt, he was early pioneer in the weightlifting world in the early 1900s, a very famous wrestler and strongman. And in The Way to Live, he talks about how to live healthy and build strength and muscle and stuff like that. And so going into the weights wisdom of the week, stuff that Hackenschmidt suggested and Eugen Sandow, the father of bodybuilding, around the same time period. And then even going into like the 1950s, some of these guys that we'll mention later on in the show, like John Grimmick, they would say, strength train full body 3 times a week, focusing on the big compound lifts and big ranges of motion. And, that still holds true today. So if it worked 100 years ago before steroids and supplements and everything like that, you can bet that it'll work today for you too.
Yeah, and a big shout out to Atlas Power Shrugged. He's a big kind of strength historian on Instagram. So if you don't follow him already, you should give him a follow because he's a big Hackenschmidt guy and like has demonstrated the effectiveness and utility of a lot of these kind of obscure lifts, like the bent over press, like Zercher deadlifts, different stuff like that. That is like totally unorthodox by today's standards, but
ground pullovers, everything like that.
Super interesting stuff. So if you want to see some like cool lifting content, go check out his page.
All right, thank you, Nick. You want to talk about all the listeners that have engaged with us throughout the show?
Oh yeah, so this is episode 100. So I thank you to all the listeners who have been listening for a while. Comment on our stuff. I think Ted and I started talking about doing the podcast, probably 2.5, 3 years ago, maybe.
Yeah.
Like the first time I thought we talked about it, we were at a concert in Chicago, I think, and we were just going on one of our rants. And then Katie was like, you and Nick should just start a podcast. And we were like, yeah, we should. And then I think over like the next few months, we were just throwing around ideas. And I think it was like November 2022 that we really started like planning it, like talking about like naming our podcast, which took like a couple of weeks trying to figure out the name for it.
What were some of the initial drafts on the names?
Oh god,
there were so many.
Yeah.
There's probably a doc somewhere. We have the OG planning doc.
We do. We should. We'll put maybe some of those throughout the beginning of this episode, original ideas. But we had a wide range of ideas because we were trying to incorporate the 5 Fs, and we were kind of narrowing it down. We wanted it to be a short name, obviously only like 3 to 4 words. And then we reached out to a bunch of family and friends, a lot of people that still listen to this show today, and got a bunch of suggestions and kind of just kept tweaking it over time. And it was about a month process just to settle on the name.
We had probably 50 or 60 different names, and then we just had people go through and rank them 1 to 10.
Yep.
And yeah.
Weights and Wealth won.
Yep.
It did.
Nice.
It did.
Nice. That's a process.
Yeah.
Coming up with a good name for anything.
Yeah.
Difficult.
And then Sean joined about a year ago, I think.
Yeah, we did. So, we did year 1, just me and Nick, and then year 2, Sean joined.
Yeah.
So we started January 2023 was the first episode. Originally, if you were back with us in those days, we were doing 2 episodes a week in the first few months, and that was little aggressive for
It was
us.
a lot, yeah. But I mean, once we're all living in the same area, if we do, it should be a lot easier.
Yeah.
Because no travel. But
All right, and now, without further ado, 100 years of weights and wealth. We'll start on the wealth side.
yes.
So the first thing listed is well outside 100 years ago.
So I was gonna have you guys guess the first stock exchange, but it seems like you're looking at it.
Yeah.
So for the listeners, if you want to take a guess when and where the first stock exchange was, it was in Amsterdam in 1609. The East, like the East Dutch India Company or something like that. Dutch East India Company. Yeah, that was like the first major company that was traded. And I think by today's standards, they would have been like a multi-trillion-dollar company.
It's not even comparable. So the Dutch East India Company at its height, like relative to the capital in the world, it would be like today if you combined Facebook, Apple, and so Meta, Apple, and there's one other one like Amazon or something. Like those three top companies, Dutch East India Company had more capital than all three of those combined. It's crazy.
So dope.
Yeah.
And
they had entire armies at their disposal.
Their capital ventures were like so much cooler. They were like, we're going to send a whole fleet of ships and an army to a place we don't even know exists.
Yeah.
And if they make it back, we'll make billions.
So I guess
but if they don't, they're just gone. And we don't know. And we don't know what happened.
I guess Tesla is the next Dutch East India Company.
Yeah, I mean, if they
SpaceX
is kind of the next East India Company, because I mean, if they go to Mars, it's gonna be nuts. And like, who knows what like rare earth minerals and like crazy stuff they're gonna find there. So if you want to go back to like the ancient days of venture capital, SpaceX is the modern equivalent. It's pretty sweet. So then in 1924, we had the first real mutual fund was created. Ted, if you want to talk about that.
Oh, me?
Yeah.
Okay. That was Vanguard. Nick, you want to get into it?
It was Massachusetts something. Are
we talking mutual or index fund? Oh, mutual fund.
This is a mutual fund.
Yeah,
so this was in Massachusetts. They just, like they would buy a few stocks and they would buy the shareholders' mutual funds back at the end of each day, which is, I mean, it's kind of similar to how it works now. Like they do a lot more buying and selling, but it's tax advantage, so you're not like taxed on the short-term capital gains. But yeah, that was like the first real one. I mean, like there were a few beforehand, but that was like the first major one. And then from there, they just got more and more popular. And then index funds didn't come along, I think, till the 70s.
Yeah, we'll get into that later.
Yeah. And then obviously we have the Great Depression of 1929. Just a lot of poor financial fundamentals kind of coming home to roost. Dow Jones went down by 90%. And, after that, I think a lot of people started to kind of be a little more deliberate about where they were allocating their capital.
Yeah, and this is also and then the SEC was formed in 1934, just to provide investors with a lot more transparency, and to kind of help eliminate fraud. Because I don't know what they did with like audited financials up until then, but maybe they weren't getting like really good audits.
I feel like it wasn't really a thing.
Yeah. So, I mean, that's why there was the Great Depression, because people were being very speculative, didn't really weren't investing based on value. Like value investing didn't come on until later. And then there was a lot of buying to borrow, buying on margin, which is really what caused the
and it's not like that's the first time that happened. There was you talked about Amsterdam, 1609 was the first stock exchange, I guess. After that, there was the great tulip crisis.
Oh, yeah.
People were investing in tulips and like tulip bulbs. It's like, why would you invest in that? But like people were just throwing money at it.
It was the original like crypto crap coin. It was the original butt coin.
Because I think people were even using the tulips as currency at one point. But yeah, and then we see it again in the .com crash, which we'll get to as well.
Yeah, so after the SEC was created, next big significant financial event is the Bretton Woods Agreement. Well, really, I mean, we had the Federal Reserve in 1913, which was a big change. And we're going to touch on the Fed in another episode. But as far as timeline goes, then we have Bretton Woods after World War II in 1944, and that kind of rearranged the whole world order around the UK and the US. being like the world reserve currencies on a gold standard. They were gold backed, so it wasn't, exactly. It wasn't like a gold pure standard as you would think it is, but it had complexities. And basically after with Bretton Woods, like that's when the U.S. kind of really emerged into the world economy as we know it today.
Yeah. Can you explain what Bretton Woods was to people who might not know?
So basically British Empire up until then was the world reserve currency because
The pound.
the pound sterling was like, if you think about it today, like people are buying U.S. treasuries and stuff because they have confidence in the U.S. government that it's stable, right? So it's a good store of value to buy U.S. debt because they're going to pay you back. It was kind of the same idea with the pound sterling, and that you would be able to. You always knew if you held pound sterlings that you would be able to redeem those for gold. After the kind of implosion of the British Empire after World War I and World War II, Bretton Woods was an agreement between the UK and the US to kind of reestablish that and help them out and in establishing a new financial world order. And the US dollar was the...
You saw that with like the Marshall Plan, how the US started to give money out to all these countries to rebuild, so all these different countries started to use the dollar as like the reserve currency.
The dollar became the building block of the, financial structure of the world. And that is why, we enjoy such a privileged position in the world today, is because we were able to export. Like if you think inflation's bad here, it's far worse everywhere else because significant portion of the inflation that happens when we print dollars goes abroad.
Yeah.
So we don't experience as much of that due to our status as the reserve currency. In 1961, we have Eisenhower's military-industrial complex address. Not necessarily like totally financial, right? But
I kind of threw this one in there.
But it does affect things, right?
Yeah, in Eisenhower's farewell address in 1961, he warned the public about the military-industrial complex and the dangers of it emerging. And after World War II, we started to have a standing army, whereas before that in U.S. history, we never really had a standing army. So when a war came along, we would start to ramp up our military, and people would volunteer, or there would be like a draft of some sort, and that's how we would get soldiers. But after World War II, we've since then just retained this standing army where even if we're not in war, we still have these 1 million plus soldiers, sailors, airmen, Marines, just constantly on active duty, doing training and a lot of administrative work.
Well, that goes back to the Bretton Woods thing, is because with our status as the reserve currency, it's kind of our responsibility to guarantee, freedom of the seas, free exchange, free trade across the globe.
Yeah.
Like when you are the reserve currency of the world, in a fiat currency world, that money is backed by your military-industrial complex. I mean, that's
yeah.
In simple terms, like the dollar is backed by the bullet. That's what it is. 1971, we have the Nixon shock where he takes the dollar off of gold, and this was because a lot of like our debt, was kind of being called, right? Like so, like maybe we took a loan out from someone and they wanted to redeem their dollars for gold, and so our gold supplies were drastically or like rapidly shrinking, and so Nixon decided to take us off the gold standard entirely, and that caused a big shock. And that is when the dollar went from something that you can redeem for a certain amount of gold, like an actual hard asset, to totally fiat, and no longer it's literally just a piece of paper. So, yeah,
Monopoly money.
Mm-hmm. And then
Nick, you want to get into the stock market with the 70s?
Yeah. So in 72, the NASDAQ launches, becomes the first electronic stock market. I mean, largely up until then, like people would just kind of sit around with like paper, or not sit around, but like stand up and yell with like papers. So like this kind of allowed people to trade more, I don't know, more efficiently, I guess, and without as much noise.
Real-time data, like not like a runner coming in and being like, hey, these guys just declared bankruptcy. It would kind of come across the wire, whether it was like a phone call and then it got, put into something, but it was certainly a large jump forward. Then 1976, Vanguard launches the first index fund to track the S&P 500. Nick, if you'd want to just real quick, explain the difference between index fund and a mutual fund. For our audience.
So index funds, like they'll hold the entire S&P or the entire Dow Jones or NASDAQ. Whereas a mutual fund, it holds a basket of stocks. So if you want to invest in like the technology space or like agriculture, like you can pick a specific basket of stocks to invest in, and they're more actively managed as well, which index funds just hold like the entire stock market.
Yeah, I always think of like index funds as being passively managed. They just kind of sit there and they have really low expense ratio, so you're not paying the company that you're buying the index fund a lot of money, whereas mutual funds are being actively managed and have a higher expense ratio, so you're paying more of your gains to the company that you're getting the mutual fund through.
And then 1987, we have Black Monday, where the Dow went down by 23%. That was obviously a big change in value. Off the top of my head, I am not super familiar with what exactly caused that, but it was definitely unexpected and a huge loss across the board. Like we have pulled up right here just a big chart, and if you think Trump's tariffs were bad, this is far worse. So a lot of people, are saying that like it wasn't really predictable. There's not a lot of stuff that they said, was the specific cause. But basically, just kind of big scary crash that happened. Not much else to say.
And then in 1992, E-Trade became like the first online trading brokerage. So this is a time when it would become a lot easier for your average person to trade. They can just easily create an account rather than having to go through somebody. I know, especially in like the early 1900s, investing in stocks was largely just for the wealthy because you kind of had to know people to invest. Over time, like eventually Robinhood came out in 2013, where it's just gotten easier and easier and easier.
Yeah. And ironic, like this was like done using dial-up internet. So for our older listeners out there, I'm sure you remember that, but that must have been wild. Like trying to place a trade on E-Trade in 1993. And you're like, oh, my internet cut out. I just lost half my net worth. That'll be tough. And then we have NAFTA in 1994. This is huge because it eliminated pretty much all tariffs between Canada, the United States, and Mexico. Critics of this, and I think most reasonable people now that we're almost 30 years removed, realize that this was probably a pretty big mistake because pretty much every single decent job that wasn't white collar got moved out of the country. Yes, it increased stock prices and stuff like that, but just remember, guys, the S&P 500 is not the economy. It's a sort of like theoretical valuation of companies, and a lot of these companies are overvalued, and it does not reflect the health of the nation in any significant way, because what percentage of Americans own stocks?
Oh gosh, I'm trying to remember.
It's like it's like significantly lower than you would think it is.
Yeah, it's either like 40 or 60%. We went over it in the Myth of Capitalism book club episode because that was one of the big focuses at the end of the book. Was that one of the big reasons for like inequality financially is due to people at the top owning a lot of stocks and people at the bottom of the socioeconomic bracket not owning stocks and not being able to grow their wealth and outpace inflation and everything.
Only 62% of Americans own stocks. So that's, I mean, it's up from what it used to be, but like that's a lot of people that don't actually own anything. So if you think nearly half of, the United States has pretty much no exposure to the stock market, well, how are they going to retire,
Yeah. And then, so you mentioned NAFTA, that was what, 94? Mm-hmm. And then shortly after that, you mentioned like jobs started going out of America, a lot of the more blue collar jobs, and then China joined the World Trade Organization in 2000 or 2001, and that further like started rapidly affecting that job displacement out of America.
Mm-hmm. And it's not only America that was affected by stuff like this. Like I just recently saw an article posted by, I think it was The Economist or someone, but like the last steel plant in England was just shut down because, ironically, it was bought by the Chinese, right? So like British Steel or whatever it was bought by the Chinese, and it had been kind of limping along. Like the British government was literally sustaining it through like subsidies and like just funding it, so that like they at least had the capability to make steel. And finally, like right after, England is like, yeah, we're gonna go into Ukraine and like protect the Ukrainians and enforce the ceasefire or like support Zelensky. The Chinese like declined the $500 billion or whatever it was that they got offered to like keep the steel plant going and just shut it down. So like England can't make steel anymore, and they're like about to go to war.
It's tough.
So it's a pretty tough look to literally not be able to make basic things. Yeah. On the bright side, also in 1994, the first fully online transaction took place at Pizza Hut.
Yes.
So we might not be able to make things anymore, but we can buy pizza online. So that was pretty cool. And then we had the dot-com bubble of 2000, and just another thing, kind of like right now, like where there's companies that are valued at like 3 to 5 times. And it's just like super overvalued. Like people are just, price goes higher and higher and higher and higher, and finally, someone called the bluff, and things just went through the floor.
Yeah, I mean, companies were getting huge valuations just for owning a domain like cars.com,
which would be
really
sick
easy domain.
If it was 2000 right now and weightsandwealth.com was like worth 15 million, you know what I mean? Like think about that. We could, if only we could time travel and just go back.
And like also during that time, a lot of people quit their jobs to try to become full-time day traders, which I mean it's kind of been like recently where anybody who's been day trading has been making money, so they think they can keep doing it, but it's easy to make money in a bull market. Mm-hmm. So that's what happened then too.
Real ones know. Yeah. So yeah, and you were saying that mid 2000s, like higher frequency trading, you kind of touched on that, but it becomes like a big, much more common thing.
Yeah, and this is when like the speed of information, I mean, it's always mattered, but this is when like tenths of a second started to matter. People would build or would get in office as close to like the center of Wall Street as possible because it makes tenths of a second of a difference. Same with, I forget who it was, but whoever installed the first like fiber cable to like the central exchange had a huge edge, and they started building algorithms that can trade. And the way that high frequency traders kind of work is they can intercept when like say like somebody makes an order in Los Angeles for like $5 million for the S&P. They know that order's coming. They can intercept it. They can quickly buy a bunch because they know that the price is about to go up, 0.005 cents or something like that. And then quickly sell after that order goes in. So, like that transaction happens in fractions of a second. And this is also who day traders are competing against, people who have built these big computers. And then you also got your quant guys that are making, 800 coming out of undergrad or MBA, who just know math very well.
The scene from The Big Short, who plays it? Ryan Gosling. He's like, look at my quant. Look how scared he is. He doesn't even speak English. He won 8 Chinese math competitions in China. Do you know how hard that is? And then it pans back to the Asian dude. He's like, I'm not even Chinese, and I was born in America. But he likes to say that because it scares the investors more. But whenever someone says a quant, that's what I always think of that scene.
Speaking of speed of information, we have 2007 with the first iPhone, so that democratizes trading even more in the stock market and stuff, and not to mention kind of a big manufacturing boom, and Apple really kind of they had made their name with the Mac and stuff at that point.
iPod,
but the iPhone is I think their flagship product.
Oh yeah.
And so that's when they really kind of, I would say, started to dominate the tech scene in the way that we are familiar with today. And then we have the introduction of Bitcoin in 2008. Thanks Obama. Appreciate it. If only I could go back and tell my dad to buy some Bitcoin. I think about that guy who bought, he spent 15,000 Bitcoins on a pizza or something.
Yeah, the first Bitcoin transaction. Yeah.
God, that guy must he's probably dead by now, just because of the amount of existential regret that he must have. I hope he saved I hope he had 100,000 Bitcoins, know, and saved the rest of them and is living life. But if that was all the Bitcoins he had, oh man, I would be so pissed. 2008, then we have the mortgage-backed securities crash, Big Short, Ted was talking about. And ironically, a lot of those same indicators are popping up right now.
Yeah, just in a different way. Instead of all the mortgages being bundled into these really kind of junky loans.
Yeah, junk bonds.
Instead of residential real estate, now you're starting to see it appear in other areas. I'm sure maybe Nick could give a better idea of that, but I think I heard the Higher Standard talk about how that's more in commercial real estate and venture capital and stuff like that this time around.
Yeah, I mean, I know commercial real estate has gone down a lot. While residential was going up, commercial was dropping a lot, largely because of COVID.
I guess for the audience, FHA loan. You're talking about residential real estate.
Yeah, it's it's a program that allows first-time home buyers to pay a lower down payment. So I think it's what the requirement's 5%, 3.5%. So basically, instead of you being required to pay with the standard loan where the bank will want 20% down or 10% down or whatever it is, depending on your credit score. FHA allows you to only pay 3.5% or 5%, whatever it is, to secure funding, to secure financing for the house. And
making it easier for someone that doesn't have as much cash or assets to then buy a house and get their family life started. But then also the downside of that is you have people that maybe can't really afford that house starting to buy houses.
Yeah.
So it's good. It's we talk about all the time, good intention from the government, but bad results on the other side.
Well, yeah, I mean, but just think about it. It's if you're going to buy a house and you're currently renting an apartment for $1,200 or whatever, and you really want to buy that house, but your mortgage is going to be $3,000, where are you going to find that extra $1,800?
I mean, that's the situation I'm in right now, because I'm paying $1,500 for rent, and one of the houses that I was looking at, the mortgage payment would have been around $3,400.
Yeah, it's
and it's just kind of I'm and then I ran the amortization calculator for the mortgage, and it's first year I'd pay $29,000 interest, get $3,000 in equity.
Yeah.
Yeah,
it's brutal. And that's why I think with the delinquency rate. I think a lot of these properties are going to start coming out of the market because, they've been getting their mortgage paid by Fannie Mae and Freddie Mac and stuff like that. Just the loan holders are getting paid, but the actual loan is not being serviced. And so eventually that's gonna have to end. And then we're gonna have, I think it was around like 9 million homes nationwide are falling under this category.
Yeah, and those are most likely lower cost properties too, I would imagine. Because I mean, like, there are still a lot of people that have their 3% interest rates that won't sell anytime soon. But I think those tend to be a little bit more expensive of houses.
Yeah. I mean, especially like people who refinanced during COVID, like, can't blame them. It's like if you're locked in at like under a 3% mortgage right now, like, why would you ever sell?
Yeah.
You know, like that's as good as it's going to be for probably the next like 15 years, you know? So stuff. 2013, we have Robinhood coming onto the scene, and you know, paired with the iPhone, that really, and it's like friendly user interface. Because I don't know how many of you guys have used like Charles Schwab and like other trading platforms, but like Robinhood is kind of like the Apple of trading platforms, where it doesn't give you all the technical data, because that would just be overwhelming, and I think that scares people. And so it made investing like a lot more fun and easy for people. Because
sign up, you get a little present that has 5% of a stock in it.
Yeah, and like you got to click on it for it to open, and there's like confetti.
Yeah, it's like, congratulations, you got $3.50 in that first stock, you know, of a company that is a zombie corporation. But yeah, so that started in 2013, and you know, so retail trading kind of became the big thing. And we'll get into retail trading in a couple minutes, but yeah, I mean, 2013, Robinhood starting, and then, you know, obviously we have other platforms out there like Charles Schwab, Webull, you know, dozens of others. E-Trade, you know, has been there since 1992. Yeah. But Robinhood was like I said, kind of like the big one that made it more open to like people who were not
democratized it.
Yeah, they democratized it. 2010 to 2020. If you want to talk about this.
Yeah. So index funds from 2010 to 2020 grew from 19% of the market to 40%. And which I think we've talked about this before, but index funds are very good for the individual, but not good for the market as a whole. Just because, you know, like the top 8 stocks are 34% of the S&P. Or NASDAQ maybe. But, you know, there's just positive reinforcement when people are just passively investing in companies. Because if you're already big, then people invest more into you because you're already big. And then you just keep growing through that process, not because you're a good company.
Yeah, so it's just kind of this, it's a reinforcement like mechanism, or like just like this self-recurring loop that just, you know, Johnson & Johnson's stock goes up because they're big and they're doing well, and they get added to the S&P 500, and now they're in there, and now technically all those people who are buying the S&P 500 are also buying Johnson & Johnson stock.
Right, and then it just keeps on going up. Yeah.
Yeah. And then we have COVID 2020. That was big. You know, that was big. That was a big event. Ironically, I'm not going to talk about it. But this is when we saw, like, you know, 2020 to like 2023, we saw the retail trading. Obviously, we saw the huge dip. So a lot of people who are familiar with the stock market was like, great, you know, buying opportunity. Either the world ends or I make a huge return, which gladly, you know, that world did not end, and a lot of people made a huge return. And then we saw kind of the rise of like Wall Street bets, and you know, Wall Street bets. Oh yeah, that's what I'm saying, dude. Is like they made a whole like Netflix documentary about it. I haven't watched it, but that was a big deal. That was a big deal. It was the first time that retail traders like almost put a hedge fund under.
Was it Citadel, Roaring Kitty versus Citadel?
Yeah.
Yeah, he was the leader of GameStop. I mean, he made millions off of that.
Oh yeah.
But yeah, this is when meme stocks started to become a thing. And I mean, there are still meme cryptos out there, which I will never understand. Like, people know that they will never be valuable, but they just buy them because it just comes.
How much Doge and Pepe do you have, Sean?
I got a couple million Pepe and maybe like 500 Doge. I paid my rent with Doge. Yeah, it was pretty sweet. No, it's because, like, you know, like it used to be worth like, I don't even know, like less than a tenth of a penny. And so anytime I would buy a stock or something, I would have like $1 left over. I'd be like, I'm going to buy some Dogecoin because I think it's funny.
That's what I did too.
I had like, 500,000 Dogecoin, and then it finally, got up. And like, if I had held it, like I think I did the math, and I would have had like 50 grand. But I sold early on, sadly, and just to pay my rent, which is a mistake. And never sell.
No, never sell.
Like the guy that bought Pizza Hut with his Bitcoin.
I am the new Pizza Hut man. But yeah, so COVID 2020, big deal. Meme stocks, market fundamentals are no longer, or like were no longer a thing. Maybe they're making a comeback, but with the prevalence of like Joe Schmo just being able to be like, I'm gonna YOLO my inheritance on X stock.
Shiba Inu.
Yeah, but there's like no predictability to that. Like these traders are not going up against rational people anymore.
Yeah, it's just chaos.
Yeah, they're just like, why is this going through the roof right now? It's because I don't know, 500,000 people on some like random internet page were like, we're gonna make this stock go up.
It's like when you're playing Catan with me, and you would think you'll be able to get an ore for 2 sheep, but then I say, no, I have all the ore. The price is now 5 sheep.
Pretty much.
Yeah. Or it's like one of our friends always tells me he likes to buy Amazon and Best Buy around Christmas time because that's when people buy a lot of stuff. And they usually do go up around then, but probably because a lot of other people are thinking the same thing.
Yeah.
So.
And then the next big event is we have the Trump tariffs of 2025. And that, still a lot of uncertainty. We are only 4 days out from quote unquote Liberation Day. So we'll see what happens. It's going to be a lot of people are all doom and gloom. A lot of people are very optimistic. From what I understand, the whole strategy is to get the 10-year yield under 4% to allow the government to like refinance the national debt, because I think what was it, like $9 trillion worth of interest was going to be
coming up,
and like they just can't handle that. So like this is their strategy to cause enough market volatility to cause more people to buy treasury bonds, which drives the yield down, right? Because more people are rushing into the debt, and will allow the government to refinance at a lower rate. That's the alleged strategy. We'll see how it pans out, what exactly happens. But we're already seeing like a lot of companies coming back to the U.S. and reinvesting in the industrial base here. So
I saw a funny meme the other day that like superimposed Cultural Revolution, China and Mao and everything over Trump with like China's 10 and 30-year plan, and it was a video of Trump in 1988, and then today, like the image of him with the board with all the different tariffs, holding up at the press conference the other day. And so then the first video was him talking in 1988 to Oprah about how like we need to be charging tariffs on all these other countries 25%, and now he's actually doing it. So it's
he had his
like
10-year
40
plan.
years later, it's funny, but
and I mean like. When you're like watching the news and stuff, just keep in mind, like we just talked about COVID, right? The same people who are going crazy and like super upset about these tariffs are also the same people that were totally okay with shutting down the entire global economy over a cold. Okay? So just keep that in the back of your mind before you take any of these people seriously. Okay? Like that's all I'll say is like the same people that were like, you're not allowed to leave your house and there will be 0 economic transactions, or like bare minimum, and they were okay with that and they were very in favor of that, are now against like some trade restriction. So just remember that before you panic, or like you watch The View or even Fox News.
You sound like Aaron Rodgers asking people to present their vac status before they ask him a question.
Yeah. All right. So now on the fitness side of things.
All right. So hit on it a little bit in the beginning of the episode with Hackenschmidt and Sandow and stuff like that, but Pre-1930s, so 1800s, you had the first gyms kind of forming in America and across the world. But you had YMCAs in Cincinnati in 1848 and then in Boston in 1860. And these YMCAs, although they were kind of like the first gyms, they were like gymnasiums that had bars and stuff, and like monkey bars and ladders for a lot of like calisthenics and stuff like that. So not what a typical gym you would think of today back then. So that was like kind of pre-1930s. But then in the beginning of the 1900s, you started to see physical culture clubs, is what they would call them back in the day. And if you read any like early 1900s weightlifting stuff, you'll see like physical culture.
It's for the culture.
Which is a cool term.
It's for the culture, you know.
But yeah, then you start to see these little physical culture gyms pop up in the early 1900s, which were, they had like barbells and different weights and stuff like that, but they were mostly for wrestlers or for like circus performing strongmen, they called them. So any of those really early guys were either wrestlers like Hackenschmidt or like circus performers like Sandow, really. And then you did have some of the wealthier people in these large cities start to join these little physical culture studios for like a pretty can't think of the word, like a pretty like new concept at the time. They were intrigued by it. Like I think J.P. Morgan joined a physical culture club in the like 1920s.
It's like keep that in mind when you look at like the deadlift index. You know, that's a reference to some dude who made like a tracker, a scatter plot of companies like now that whose CEOs are like publicly fit. You know, whether they're like, you know, Zuckerberg doing his Brazilian jiu-jitsu or Bezos who's probably on trend. You know, but just like CEOs who are like mogging people. And their stocks have outperformed the S&P 500. So, you know, like in J.P. Morgan joining a physical culture club back in the day, he was like the godfather of investment banking back in the day. So, those two things may or may not be directly related. Say correlation, it does not equal causation, but sometimes causation does happen.
Yeah. Moving on to 1936, during the Great Depression. This is like what's widely considered the first gym as we see gyms today, created by Jack LaLanne in California. If you don't know who Jack LaLanne is, definitely look him up. He's considered the godfather of fitness. Like Sandow before him was considered like the godfather of bodybuilding. Jack LaLanne was considered the godfather of fitness. And he was kicked off the Olympic wrestling team in 1936 because he was, quote unquote, charging people for exercise with his gym that he opened, which is a pretty like funny charge to get kicked off the Olympic team for. But it was this really new concept at the time, and people just didn't really understand it. LaLanne talked in his lifetime. He only recently just passed away in 2005. I think around 2005. He lived until almost 100 years old. Really practiced what he preached throughout his entire life, but he would say when he was alive that back in those days, doctors would tell their patients that LaLanne was a fitness nut and that his practices would make them muscle bound, give them heart attacks, get rid of their sex drive, and cause a host of medical problems, which is hilarious because as we know today, like exercise and lifting and that kind of stuff and having a healthy diet does the opposite of those things. So it's just, you know, we have a little bit of a beef with the medical profession sometimes on this show, and I guess it's been going on for 100 years.
Gym bros versus doctors.
Yeah. Then 1947, so 11 years later, the first Vic Tanny Health Club opened, and these were more like suburban gyms and looked a lot more like what your normal gym today would look like. So although LaLanne's club was the first gym that was open to the public and had weights and stuff like that in it, the Vic Tanny Health Clubs had like pools and saunas and weights and cardio machines. So more of like today a health club that you would think of in like a suburban area. Vic Tanny started the first of that kind of gym in 1947. and it quickly expanded and grew. And the Vic Tanny Health Clubs were the first gym chain to reach 100 locations. And that gives you any indication of just how successful this model was at that time. So moving into the 50s, in 1951, Jack LaLanne, again, look him up if you've never heard of him. He started the Jack LaLanne Show on TV on local networks in California. It ran for, almost 35 years, I think, into the 80s. But he started on local TV in California, giving like exercise advice and nutrition and cooking advice, and just doing different things to promote exercise. And then in 1959, it became a national TV show. I have it written down. Yeah, it went until 1985. And some of the advice like in the show included, if man made it, don't eat it. Very pioneering, good advice. Yeah. Because people didn't really realize the dangers of processed foods when they came out, for the most part. And then other stuff such as exercise is king and nutrition is queen. Together you have a kingdom. Something else, I'm not sure if it was on the show or not, but that I came across when I was reading into Jack LaLanne a little bit more, was he actually, I think, was the first person to demonstrate the analogy that we've talked about on this show, which is that like you have a health account kind of like you have a financial account, where the more you put in, the more you can take out. He actually was the first to kind of make that analogy.
Interesting.
So now that we've got gyms becoming more popular, between the 40s and the 60s, you have the silver age of bodybuilding. So this is when lifting and growing big muscles started to become more relevant to the culture. So in 1939, you had the first Mr. America show in Schenectady, New York, up by where I'm from originally.
Schenectady. What language is that?
But this ushered in like the Mr. America, the Mr. Universe, all these kind of bodybuilding shows that became a part of culture. So do you guys know about any of the silver era bodybuilders?
I mean, there's the one guy who's known for the eggs.
Frank Zane.
Yeah,
Frank he'd Zane. Be a little bit later.
A little bit later? Okay.
Yeah, he's more like 60s, 50s, 60s, I think. So, guys during the silver era would be, I think I mentioned John Grimmick.
Vince Garanda.
Vince Garanda, I think, was also
was
like 60s, 70s,
okay.
Yeah. But you had John Grimmick, Steve Reeves, you had guys with incredible physiques kind of before the steroid era. I've got steroids next on here, but these guys were building incredible physiques. A lot of them were probably genetically predisposed to build a lot of muscle, but just doing a lot of 3 times a week full body lifts. These guys were packing on a lot of muscle and looking really good. So that did start to popularize it to the culture. So here I've got steroids. Sean, if you want to give my voice a break and read that bullet.
Yeah. So 1950s to 1970s, steroid adoption became very popular in bodybuilding, and elite athletics didn't really spread into the gen pop until like the 1980s. So like that's when you kind of start to see like the Arnolds and that type of guy. Obviously Arnold didn't like peak until like the 80s, but that's when you start seeing like bigger and bigger and bigger guys who are like sort of unrealistic. Like I'm a firm believer that like a mid steroid physique is totally achievable naturally. I think your natural limit is what you set for yourself, and I think a lot of people just will look at someone who is quote unquote enhanced and just kind of give up. But like you were saying earlier, like in the silver era, like there weren't steroids, and there were guys who were very strong, high performers, and built a lot of muscle, and they didn't have anything like that. They were just eating proper food and like training with good intensity.
Yeah. In episode 80, it was the episode we recorded right after the Trump assassination attempt. But if you want to skip through that, if you don't care about that, and go to the end of episode 80, Sean and I went through a lot of these silver era bodybuilders and looked at like what you can expect to achieve naturally if you train correctly over a long period of time. And so we have pictures of a bunch of those physiques in that episode at the end. If you go to around the 50-minute mark, episode 80, you can see a lot of these guys that we're talking about and see some of these physiques that are kind of like the cap end of what you could naturally achieve.
Yeah. And then 1960 to 1983, golden era of bodybuilding. You know, that's Arnold, Lou Ferrigno, Frank Zane, Franco Colombo. That's like, you know, you go on any social media, especially if you're like interested in fitness, you're going to see like the fitness edits of, you know, like Gold's Gym and, you know, like just the 1980s vibes and what's going on. That's really like the I would say the high point of bodybuilding, and like, you know, even though like the mass monsters of like the 2000s, you know, kind of are well known today, it's still like when people think of bodybuilders, they think of like Arnold and, you know, Lou Ferrigno and stuff like that.
Yeah, that era of Arnold, Tom Platz, Frank Zane, those guys, really, really cool to like. I mean, just from like a physique perspective, to see that explosion of like what these guys were able to do. But then, so there you start to see people become even more enamored with bodybuilding, and with that popularization of people like Arnold, who was then, you know, some of these guys started to appear in movies in Hollywood, and a muscular physique became more desirable. Because of that, throughout the 70s and 80s, you then had this explosion of fitness into all these different branches. Because not everybody wanted to look like that. And some people were scared to go lift weights, especially like more on the female side. Which interesting about Jack LaLanne, he would have his wife on the Jack LaLanne show in like the 50s and 60s and 70s doing the exercises with him to like show people. And one of his points was, hey, women, like, you guys can lift too, and like you'll look like my wife. You won't look like some of these crazy muscular dudes. Like, that won't happen to you.
That's, and I think that myth still persists today.
Yes.
So sadly,
I think it's getting a lot better.
But
so then throughout the 70s, so I wrote in here a reference to Anchorman, but in the 70s, jogging and like marathons and everything exploded, and it reminds me of an Anchorman, the scene where he puts his Walkman on, Will Ferrell, and he's like, yeah, I'm gonna go yogging. It's this new trend. And they're like, what do you do? He's like, oh, you just kind of go and run. And they're just like, why would you do that? But yeah, like jogging wasn't running wasn't a huge thing that people did for exercise. In the 70s, it really, really took off.
I mean, I would assume like track and field were a thing, but like not like endurance.
Not for the everyday person. This is where it's like you start to really see like 60s, 70s, 80s, like the average person having a fitness component to their life and their schedule really, really exploded.
In the 80s, we had aerobics classes and video aerobics. Like, think about like the goofy, you know,
jumpsuits,
the jumpsuits, and they're like, you know, kind of the precursors to like Zumba, and they're just like, woo, woo, like, you know, the kind of like the dance fitness. I don't really know how to describe it. I've actually never watched one of those whole videos.
Just the meme clips.
But I've seen like the YouTube's videos, and they're just painful.
Yeah, this is when Jane Fonda became super popular with like workout tapes that people would follow along with. I guess kind of precursor to P90X here, but the aerobics trend in the 80s really took off. So moving into the 90s, this is where you'll be probably more familiar with these bodybuilders of the 90s, but as Sean referenced earlier, they're often called the mass monsters. They started to really push the upper limits of like how much mass you could put on with growth hormones and steroids and stuff like that. So you've got Lee Haney in the 80s and into the 90s, winning, I think he won like 7 consecutive Mr. Olympia titles. And then you had Dorian Yates win a bunch in a row throughout the 90s. And then at the tail end of the 90s, you had Ronnie Coleman.
Lightweight!
Insane. So this further spurred the popularity of bodybuilding. And this is also when supplement companies started to get huge. Was the 90s with the increased popularity of bodybuilding and with the
bodybuilding.com, you know, any type of like the online fitness forums, stuff like that. I actually saw like a really funny tweet about this guy who was putting out like fake news on some fitness forum, talking about how like raw onions are really good for like boosting your testosterone or something, and some guy
raw garlic.
Yeah, some guy like tweeted about how he ate like 3 raw onions that day and was like feeling so good. He was like, my plan worked. He just seeded all this misinformation on the internet, like 10 years ago. And now some dude is like eating onions.
Yeah, so 90s.
Be careful about what you read on the internet. Not all fitness advice is good or true.
Well, but 80s and 90s, you had all these magazines that were really big, Muscle and Fitness and stuff like that. And, they didn't always have the best information either. And then, but similar to what we talked about, same time period with 100 years of wealth, with the democratization of the internet and stock market and E-Trade and stuff like that. Like 90s into the 2000s, you start to have this democratization of information as people are going on online forums. You had bodybuilding.com, which you mentioned.
Yes.
Bodybuilding.com started in 97, I think. Do you know the original name of bodybuilding.com? Or would you like to take a guess? It was formerly like a supplement name for the website.
Oh, I don't know, growth hormone?
No. It was originally wholesale-creatine.com.
Really?
Was the origin of bodybuilding.com.
Interesting.
So that's kind of that parlay of, as we're again making it more as fitness is becoming more applicable to the average person here. You have the supplement boom into the online boom. And then in the 2000s, like boutique fitness kind of classes and niches started to become more popular. So you have Orange Theory at the end of the 1990s, CrossFit in 2000, Pure Barre in 2001, and SoulCycle in 2006, just to name a few. So
and then Peloton and, even farther on, it's like stuff like this is, there's always innovation in the fitness space.
Yeah. And so then more recently you're starting to get all this like computer and electronic integration into like cardio machines and some weightlifting machines as well and stuff like that. And then I have post 2005, holistic health starts to become a major focus as chronic disease rates really continue to rise. People started to, because like with Jack LaLanne early on in the 50s, he was talking about diet and all this stuff, and a lot of those early bodybuilders we mentioned, Garanda, Frank Zane, they talked about sunlight and nutrition and sleep and stuff like that. But then as drugs became more popular,
but also as the American diet became more and more processed.
Yeah.
It's like back in the day, like Frank LaLanne probably didn't have to worry about Twinkies and stuff.
Jack LaLanne had that quote in the 50s of, if man made it, don't eat it.
But still the majority of food available,
processed foods,
the majority of food available was still like what we would consider organic. So that was not really something that they had to worry about. And then, going up throughout the ages, probably in the 80s and 90s, that's when it started to kind of become a thing. But that's also when, PEDs were a thing. So these guys probably didn't notice, Like I bet you if PEDs were not a thing and they were eating, the processed foods that were available and stuff, I bet you their physiques would not have been as good as the Silver Age guys.
Probably. I would agree with that, I still think that, like, the more recent physiques in bodybuilding aren't as good as the Silver Era. I think the Silver Era bodybuilders looked the best because they were really big, but it still looked proportional. And they were ratio.
So
and
they were like an amateur show now.
Exactly. And they were lean, more like an amateur show, but they weren't like on life support, shredded with 0.1% body fat. It just looked more like healthy, I guess. And then the last thing on here, so we did farm out ideas for this episode to the listeners. We put it on Instagram. We reached out to some of our listeners that engage with us a lot, asked them, what should we do for episode 100? Someone came up with this idea, 100 years of weights and wealth. And then one of the listeners also put that we had to make sure at the end of the episode we included one of the best innovations in weights in the last 100 years.
And wealth, too.
And wealth is January 2023, the spawning of weights and wealth.
And then that is the end of history, as Fukuyama said.
Yes.
It's all over now. You don't need to go anywhere else. It's just us.
So hope you enjoyed this episode. A little bit of a different episode, but we thought it was a good one for episode 100. So if you've been with us for a while, or if you just joined us recently, Thank you for listening, and thank you for engaging with us. And our goal is to keep getting better as we do this for 100 more episodes.
Always happy to hear feedback, and see you at episode 2.
Thanks for joining us today at Weights and Wealth, and don't forget to apply today's lessons to live healthy and wealthy.
If this conversation will contribute to your fitness and financial gains, please share it with a friend or family member and give a 5-star review so more people can lift bigger weights and get bigger bank accounts.